Anton, it is great to see you this morning. Thanks so much for joining the conversation. What are you expecting this earnings season? Let's talk banks. You are an investor in big and small banks for years. What are you expecting from earnings in the third quarter?
I think that I'm expecting good earnings. The makeup will be boring. Credit quality continues to be awesome, so I think there's a source of strength. Mortgage, probably starting to head back down. And certainly on the banking side and trading side, it's less, growth over since the last quarter, but a lot of growth over last year. So capital markets remain strong, but the numbers will be ho-hum. There's no loan growth. And I think that that's what people are waiting for. So it's all about talking about what's on the come. And I think a lot is on the come. The yield curve has improved a great deal. And I think growth is coming as people pay down all that government stimulus they got. They're eventually going to dip into savings and start to borrow money again.
Yeah, I mean, it's a real head scratcher as far as why we haven't seen a bigger move in loan growth. Don't you think? I mean, here we are in an economy that is growing. Even if Nancy Lazard, Cornerstone Macro, took her GDP estimate down to 2% for the third quarter, we're still talking about growth, but loan demand has been just okay, not great, for over a year now, right?
Yeah, well, so much money got pumped into the economy that everybody's flush with cash. The bond markets were very strong, so companies that could issue bonds issued bonds at very low interest rates. So the banks may have, on the investment banking side, benefited, but loan growth just hasn't been there. Corporations are flush with cash, and there's bottlenecks everywhere. The supply chain's a real issue, and the labor force is a real issue. If a company wants to go build its own supply chain, it's a real issue hiring people for that supply chain because they're all short of employees. All those benefits cause people to stay home.
Yeah, it's a great point. So, Anton, do you want to focus, when you're talking about the big banks, you want to focus on those capital markets, strong banks, because mergers are on track to hit their highest level since the financial crisis. You've got deals totaling better than $54 billion announced this year when it comes to M&A, and I know even, markets have also been strong in terms of trading. So that's one area, as you mentioned, of strength and growth. Where do you want to be allocating capital, knowing that the capital markets business are strong while loan growth we're still waiting on?
Well, it's really interesting because, market cap has always been an issue, and there's so much money dedicated to the large that some of the smaller investment banks trade at really big discounts. Companies like a Cowen traded a really silly discount to the much bigger companies, and people go, oh, the SPACs, the SPAC thing is over. Well, what about all those SPACs that already exist, and all the advisory fees are going to come from all those SPACs that have to do deals? So, Cowen and Jefferies are both going to benefit a great deal from the capital markets as well as the big. The IPO calendar is incredible. The ability to get deals to market continues to be very, very strong. So I think that, Wall Street is doing very, very well, and that issuance is going to continue, and the deal making will continue, quite well into the future. I think where I like to focus, go ahead.
No, please continue.
Okay, so where I like to focus is on the, the mid and smaller size banks that can, focus on geographies that are growing much better, or can do M&A or products that have much more growth. And so if you look at ho-hum growth for the industry, you've got tons of loan growth in Texas and Tennessee and Florida, and in the Southeast in general has much better growth. And then you've had a lot of disruption from much bigger mergers. PNC, BBVA has caused a lot of loan officers to be taken, by the smaller banks. This Union Bank Cal by U.S. Bancorp will, lead to a lot of hiring by smaller banks of some of the talent there. So I think there's a lot of growth that just can happen from those geographies, as well as, improving your lending staff. And I think cost cuts are going to continue to be a very, very big. Yep. Cost cuts will be a very big thing in this industry, right? Branches are going to be closed. Technology's been pulled forward 5 years by this pandemic. And, banks are still trying to figure out how to close branches. Yeah, so financial technology isn't just a threat to the bank. It's an opportunity for them to employ that technology to improve the efficiency, to improve the customer experience, and improve the reach of the customers. And I think a whole digital currency thing is a real opportunity as well.
And at this point, they've got to keep up with one another. So if one bank is much better on tech, you've got the competitors needing to keep up. I know you've had a lot of great winners in the regional bank space, Anton. What about regulation? Because Senator Elizabeth Warren is reintroducing a bill. She did so last week that would ramp up scrutiny of mergers between the country's banks. Anton, this is the latest in a series of moves by lawmakers to crack down on business practices that they say are harmful to competition. Obviously, Elizabeth Warren is increasingly important in Joe Biden's America. Your thoughts on what might come out of Warren's office with regard to regulation in banks?
Sure. I think that, she's really saying a lot of the same things she's been saying for years. I think the really important thing to monitor is much more the Federal Reserve and who becomes the chief regulator there. I think Lael Brainerd is certainly one of the candidates. And she's really spoken a lot about banks that are above $250 billion in assets. So I think those below that really actually have an advantage. I think they'll be under less scrutiny. I think there'll be some more transactions that'll be favorable below that market cap or asset cap. But I think that's where the teeth will be. It will be at the Fed.
Really interesting. Real quick, in terms of allocating capital, Anton, your favorites are where?
Well, I love the Southeast and Texas and Florida, but I'm going to give you a couple new ones in the greater metropolitan area. I'm going to give you 3 banks that have spent a lot of time in technology. I'm going to give you New York Community Bank, which has a very large dividend, so you're being paid to wait for a merger they're closing. But a lot of technology initiatives there. Metropolitan Community Bank, which just raised some capital, and they're putting it to work, and they're really enabling lots of banking as a service customers. Again, really sound credit quality. And then Connect One over in New Jersey, which also does a lot of lending in New York, that also is leaned forward towards the fintech angle.
All right, great ideas and new ideas. Anton, it's always a pleasure. Thanks so much.
Always a pleasure.
All right, Anton Schutz joining us this morning from Mendon Capital.